Good evening, everyone. My name is Assaf, and I'm a partner here at Allegiance Financial Group Advisory Services. Along with my other partners, Sean Williamson and Charlie Cook, as well as the rest of the team here at Allegiance Financial Group, I would like to welcome everyone to tonight's webinar and thank you for taking time out of your busy schedule to join us. Some housekeeping items. In the webinar format, all participants are muted and your video is off for privacy reasons. The webinar will be recorded and will be available for replay. We encourage you to go to the full screen mode so you can see the materials that will be shared in the webinar, and also encourage you to ask questions through the Q&A box. We will monitor them and pose them to the speaker as they come in. Only panelists and hosts can see the questions for privacy reasons. If we don't get to all of the questions, we will follow up directly after the event to answer them. As some of you know, at Allegiance Financial Group, our approach to wealth management is very comprehensive. We strive to help our clients achieve what matters most to them, not only by helping them manage their money, but also by partnering with other experts such as attorneys, tax experts, and other subject matter experts to help our clients with advanced planning areas such as making sure their loved ones are taken care of, protecting against potential liabilities and risks, and mitigating taxes. Tonight's speaker is a good example of that. Our speaker today is an expert in the area of dental M&A and DSO transactions. And that is, again, another example of how we work with other experts to help our clients and our dental clients, for example. Typically, their largest asset is their dental practice. And as they get toward retirement, maximizing the value of that asset is very important. At this time, I'd like to introduce my partner, Charlie Cook, to tell you a little bit more about that and introduce our speaker. Charlie?
Thank you. Thank you, Assaf. My name is Charlie Cook, and I'm really excited about this presentation for a lot of reasons. One of the main reasons I'm passionate about the dental profession is that I grew up in a dental family. My father was a practicing periodontist for over 40 years, and we literally were surrounded by dentists our entire lives. As kind of a side note, pretty much every vacation that we went on with my family was based around a dental meeting. And crazy enough, my wife's father was a practicing dentist as well for over 40 years. So we literally have been around dentists for quite some time. So that should probably surprise no one that when I got into the financial services industry in 2006, my focus was working with the dental profession. I've worked with dentists since, roughly 20 years in some form or fashion. Maybe it's on the retirement plan side, insurance side, working with their expert team, working with our expert team as well. And, that's something that I believe my father and a lot of other dentists have not had the opportunity to work with an expert team because there are a lot of options and strategies and possibilities that may have been missed because my father may have not had an expert team at the time. And so that's what I'm most proud about today with this presentation is to learn about, our team and working with our expert team as well. Our speaker is an expert in DSO transactions and also has spent quite a bit of time on the M&A side, help facilitating over 1,000 dental practice sales. So with no further ado, I'd like to introduce our principal and CEO of McLaren Associates. Thank you, Brannon.
Absolutely. Thanks, guys. Pleasure to spend the next hour or so with everyone talking about DSO affiliations. We're going to cover a lot of ground. We want to make sure you get your questions answered. So as Assaf said, on the right-hand side of the screen, there's a Q&A panel where you can type a question in and hit send. We'll see those questions throughout the presentation this evening. Make sure that we either address them tonight or we follow up with you afterwards for a one-on-one call to make sure we get your questions answered. As Charlie said, I'm Brannon Moncrief, Principal and CEO of McLaren and Associates. I've spent pretty much my entire professional life on the business side of dentistry. I spent about 8 years as a banker lending money to dentists all across the country to acquire, start, and expand practices. And 13 years ago, I purchased McLaren and Associates. So my firm's been around 35 years. The legacy business that I inherited was kind of a mom and pop, small practice brokerage firm, exclusively focused on private party, what we call doctor to doctor practice sales in Texas, and grew that business substantially over the course of about 6 years. And then 7 years ago, being based in Texas, we were kind of on the forefront of a lot of the DSO consolidation that started to occur. This iteration of DSOs that buys high quality practices and just supports them behind the veil from an operational perspective really caught fire about 7 years ago. And Arizona, Florida, and Texas were hotbeds for the early onset of that DSO consolidation. And we quickly realized that we needed to pivot. We needed to build out a team, build out a process to provide sell-side advisory for larger practice owners, elite practice owners who are looking to go down the DSO or private equity path as an alternative to the more traditional practice sale, eventually selling their business to another clinician when they're close to retirement. So fast forward to today, we've closed over 200 DSO affiliations nationwide. We are truly a nationwide company representing both DSO transactions and doctor to doctor traditional practice sales. I'm headquartered in Austin, Texas. That's where I live, and where about half of our team sits. We also have an office in San Diego on the West Coast and an office in Atlanta on the East Coast. We work across general dentistry and all dental specialties. And we typically close anywhere between 50 to 70 transactions a year exclusively in the dental space. So in summary, I've seen everything that can go right and go wrong in a practice sale. And I'm going to share a lot with you tonight about our perspective on the DSO world. So I could spend 3 hours talking about traditional practice sales from a doctor to doctor perspective. We still have a very robust part of our business that handles those types of transactions. But tonight, I'm exclusively going to focus on talking about DSO affiliations. So I think it's important first to level set and to make sure that you understand the terminology that we use in the DSO space. EBITDA has obviously become a huge buzzword in our space. Now, that's an accounting term that's been around forever. The reason that it's become such a big talking point in our space is because private equity and DSOs value businesses based on a multiple of EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Think of the EBITDA as absentee owner profit. If you didn't work chairside in your practice and you had to pay another clinician to produce the dentistry, after you pay all your overhead and pay that dentist to do the dentistry, how much profit is left over at the end of the day? So it's revenue minus true overhead expenses after accounting for any non-cash expenses like depreciation, amortization, after accounting for any discretionary or personal expenses you're writing off through the business, and then backing out chairside comp at a market rate. So if we're talking about a general dentistry practice, it's going to be 30% of doctor collections. If we're talking about a specialty practice, it could be anywhere from 30 to 40% of doctor collections. So valuation through the lens of a DSO is always going to start with calculating the EBITDA and then applying a multiple to that EBITDA to ultimately arrive at the practice value. Most DSOs are being funded by a financial sponsor, either in the form of a private equity firm or a family office. A private equity firm is essentially a business entity, a financial firm composed of business people with the goal of raising capital from high net worth individuals and institutional investors and deploying that capital by starting or acquiring multiple businesses, typically across different industries, and deploying that capital in what they call a buy, build, and sell strategy. So in the dental world, what they're typically going to do is they're going to buy a multi-location practice with EBITDA of 2 million plus, and then start to build infrastructure and economies of scale around that business, and then start and or acquire additional practices, build it up, improve the profitability, and then within, let's say, a 4 to 5 year window, sell that DSO to the next financial sponsor who's going to pay anywhere from 10 to 15 times EBITDA for that business, and then repeat the process. Grow it larger, leverage economies of scale, improve profitability, and in a 4 to 5 year window, what we call a recapitalization cycle, exit that business upon a recapitalization event. And at a recap event, the financial sponsor, the investor, along with the DSO's management team, along with the doctors that are typically holding equity in that DSO, have the opportunity to liquidate that equity in part or in full, hopefully at a handsome return. That return on invested capital is referred to as arbitrage. So arbitrage is just a fancy word that Ivy League MBAs use to describe gain. So most DSOs are targeting a 3 to 5x return on invested capital in a 4 to 6 year recapitalization cycle. So if they invest $1, they expect that that dollar is going to increase in value and be worth somewhere in the range of $3 to $5 when they go to sell that DSO to the next investor. When a recapitalization event occurs, while there is a liquidity event, the DSO stays intact. Typically, their management team stays intact, all their practices stay intact. Only the financial sponsor switches seats. All DSOs are funded via a cash investment, what we'll refer to as equity, along with doctors that are exchanging a part of the value of their business in exchange for equity in that DSO, and leverage. Most private equity-backed companies are highly leveraged, and leverage means debt. So interest rates and the availability of bank debt play a large role in the buying behavior, valuations, and returns in the DSO space. We'll talk about deal structures here in a little bit, but all deal structures are typically going to involve some level of cash, let's say 50 to 70% of the value of the business you'll receive in cash at close. And there's going to be likely an equity component, either joint venture equity, meaning retained equity at the practice level, or holding company equity, which is the stock in the DSO's holding company. Two very different forms of equity. They function very different, both along the way and at a recapitalization event. And finally, I think it's important to understand, how does private equity make money in our space? Why are they buying dental practices? How are they generating that, 3 to 5x return on invested capital? So in large part, it's a cost average game. So they're going to buy a number of practices, say 50, 100 practices, at a cost average of, let's just say, hypothetically, 7 times EBITDA. And then at a recapitalization event in 5 years, they're going to sell that DSO to the next financial sponsor, let's say at 14 times EBITDA. Simple math. If your cost average is 7 times EBITDA, you sell at 14 times EBITDA, you double your money, right? Well, not exactly. You juice your return on equity through the proper use of leverage, of debt. And I'll relate it to buying and selling a home. So let's say you buy a house for $400,000 and 5 years later you sell that home for $800,000. Simple math, you doubled your money. But we all know that typically when you buy a home, you don't use 100% cash when you acquire that asset. If you did, then the math is simple. It's correct. You doubled your money. You got a 2x return on equity. But most of the time, you're going to fund that acquisition with a combination of cash and debt. So let's say you buy that $400,000 house. You put $100,000 cash down. You borrow $300,000. 5 years later, you sell that home for $800,000. Well, that is a $400,000 gain, right? But your initial cash investment was only $100,000. So you got a 4x return on that initial cash investment through the use of leverage. Private equity does the exact same thing, along with the fact that they are able, once they have some substantial size to them, leverage economies of scale, which an individual practice owner does not have access to. Essentially, they throw their weight around to negotiate better reimbursement rates with payers and better pricing with vendors. So let's talk a little bit about the evolution of the dental industry, because the dental industry consolidation has definitely gone through multiple waves now, and they function very differently. So DSO version 1.0, this was kind of the clinic style model. Most of these DSOs did not acquire practices. They were using a de novo growth model. They were starting practices from scratch, and all the practices were branded consistently. All the systems were consistent from practice to practice. But typically, they were not focused on providers. They were not focused on staff fulfillment. They were not focused on the patient experience. They were mainly just high volume, chop shops. And they're really what gave DSOs a bad name. For a long time, DSO was a 4-letter word. And to some of you, it may still be a 4-letter word. But in this model, they were not provider centric. They did not allow the doctors to invest alongside private equity. The suits were making all the decisions. The doctors did not have clinical autonomy and certainly didn't have operational autonomy. Most of that early iteration of DSOs crashed and burned. Most of those DSOs do not exist today. There's a handful of legacy DSOs that are out there that still exist today that may have 50, 100, 200, 300 locations that are all branded the same. But in large part, that model failed. And DSO version 2.0, 7 to 10 years ago, kind of reinvented the way that private equity and DSOs view our space. This new iteration of DSOs focused on acquiring quality practices and providing the doctor with pure clinical autonomy and ensuring that it was a provider-centric model, a staff-centric model, and a patient-centric model. They basically just help manage the business behind the veil from an administrative perspective, leverage those economies of scale, and simply through doing that and the financial arbitrage associated with buying low and selling high and the proper use of leverage, they can generate a fantastic return on invested capital without buying practices and trying to reinvent the wheel and upsetting the founder, upsetting the staff, upsetting the patients. So this new iteration of DSOs is focused on partnering with quality practices and quality doctors, allowing the doctor pure clinical autonomy and a lot of operational autonomy, supporting the business from an operational and administrative perspective, staying out of your way clinically, and then allowing the doctors to participate in investing alongside private equity and reaping those rewards at a recap of that. So for many years, we didn't even bring up the DSO option to our clients for fear that they would run us out of their office. But the reality is this new version of DSOs, what I'll call version 2.0, is a legitimate transition option. There are a lot of legitimate DSOs out there today that operate just in the way that I've described. And we have over 200 clients that have affiliated with this type of DSO that have had great experiences. Now, I do want to point out still that not all DSOs are created equal, right? There are great DSOs out there. There are terrible DSOs out there. I would also point out that there are great private practices and great clinicians out there. There are terrible private practices and terrible clinicians. So our goal as sell-side advisors is to vet the DSOs in the marketplace and only allow the best of the best options to sit at the table and have a conversation with our client about a potential partnership. The other thing that's happened in our industry over the past decade that was not prevalent previous to that time frame is the emergence of group practices and emerging DSOs. And what I mean by that is I didn't talk to a lot of practice owners that had, a large 8+ op practice with multiple doctors working under one roof and potentially being multi-specialty up until about 10 years ago. Most practices were 1 to 2 doctor practices, relatively small footprint, 3 to 5 ops, doing on average $1 million in top line revenue or less. Well, over the past 10 years, we've seen more and more group practices with large facilities with multiple doctors working under one roof and multi-million-dollar top line revenue and EBITDA of $500,000 to $5 million. Those are the types of assets that private equity wants to acquire. So our industry has evolved into a place where there's a lot of assets that fit the mold for what private equity and DSOs are looking for. And I'll talk about in a minute what they consider a Class A asset, how to position yourself to be an acquisition target for a DSO. Let's talk about market conditions. I think it's important to talk about where the market's been in order to really conceptualize where we're at today. So pre-COVID market conditions, dentistry was arguably one of the hottest verticals that private equity was investing in. Dentistry kind of fit the bill to a T as to the type of industries that private equity likes to invest in. So pre-COVID, practices were selling for anywhere between 5 to 7 times EBITDA, and there was strong demand. Dentistry had proven to be recession-proof over and over and over again, which is one of the reasons that private equity loved it going into COVID. And then it proved to be pandemic-proof. Dentistry rebounded as fast or faster than any other healthcare vertical out there. Private equity already loved dentistry. When they saw how fast it rebounded from COVID, they were head over heels in love with dentistry. So demand from DSO buyers increased exponentially post-COVID. So those PE firms that were already in the space, that owned a DSO and were acquiring practices pre-COVID, they started buying practices at an even faster clip. Those private equity firms that were eyeing an investment in dentistry pulled the trigger, bought a platform, and started building a DSO. So valuations increased rapidly in 21 and 20. Valuations went up, ballpark about 40% post-COVID comparative to pre-COVID. And DSOs were buying every business they could get their hands on. I could literally sell almost anything to a DSO in 2021 and 2022. So very, very frothy market, elevated valuation, sky-high demand during those years. And then, almost overnight, interest rates doubled. Faster than they have in the history of the Fed, interest rates increased. And a lot of these private equity-backed DSOs that were carrying a lot of leverage were not prepared for interest rates to double overnight. And it considerably hurt their cash flow. Combined with the fact that in 21 and 22, they were buying practices in an undisciplined manner, right? They were paying elevated multiples and not doing proper diligence on the assets they were acquiring. So in 23 and 24, the industry went through a bit of a reckoning, right? Some DSOs that were overly aggressive in 21 and 22, maybe they were over leveraged or they were over their skis operationally. They bought so many practices, but were not really positioning themselves to integrate and operate that business long term. They were on their heels in 23 and 24 and not buying practices, or at least, they were a little bit more sheepish in regards to what they were buying and the valuations they were offering. There were some DSOs that were built on a very strong foundation that were disciplined in 21 and 22 that continued buying at a pretty steady clip in 23 and 24. Those DSOs that were sidelined were replaced by smaller emerging DSOs that took on private equity capital shortly after COVID and had plenty of runway from a cash and debt perspective to continue growing in 23 and 24. But it has been a mixed bag, over the past couple of years. It's been a little bit more challenging to get deals done. There's more diligence being done by the DSOs. They're evaluating whether they can actually integrate and operate those practices long term. And they're being more thoughtful about what they buy, what they pay, and how they structure deals. I would say that from a long-term perspective, that is good for our industry. A lot of the players that were not behaving responsibly are sidelined and maybe sidelined indefinitely. Some of them have come back to market more recently once they got their shop in order. And then, like I said before, others have been, slow and steady. But the reality is today that valuations are slightly lower than they were at their peak in 21 and 22. They're still elevated compared to where we were at pre-COVID. And DSOs are definitely more disciplined in their buying behavior. Because of two major factors, I think the market will continue to improve over the next 6 to 12 months. We've seen multiple recapitalization events of medium to large DSOs just in the first quarter of this year. And I would attribute that to the fact that we're now in a declining interest rate environment rather than an increasing interest rate environment. Private equity feels that the election was a favorable outcome. They felt that Trump would do everything possible to be pro-business and reduce interest rates. That outlook's been a little choppy over the past few months with the tariffs and everything that's been going on. But I think long term, private equity is right. And we're going to see interest rates continue to decline, which is going to be good for private equity backed businesses. I kind of already touched on most of these other elements of the current market conditions. The one thing I will say is that deal structures are evolving to preserve cash and align incentives. So you're seeing more structure to the deals, right? You're seeing 50 to 60% in most cases cash at close, and then an equity component where the DSO has alignment with their doctors, not only at the parent company level, but also at the practice level. You are starting to see some earnouts, seller notes, preferred A equity start to creep their way back into the deals. So deal structures look a little bit more like they did pre-COVID as opposed to immediately following COVID. But valuations are still at an elevated multiple. So let's talk about what type of practices DSOs are looking to acquire. First and foremost, geography matters. So most DSOs are looking to acquire practices in a urban or suburban geography. And it's for two reasons. One is recruiting, both doctors and staff. Larger labor pool in urban and suburban markets, therefore, it's easier to recruit. And key man risk is a big deal when you're talking about provider-centric businesses. As all of you know, we've been through a serious labor crisis post-COVID in the dental world. DSOs would prefer to be in a place where they have a larger labor pool to recruit from, as opposed to a tertiary market or a rural market. That doesn't mean that if you're located in a tertiary market or a rural market, that there's not going to be a demand for your practice from DSOs. It just means that all other things equal, you're likely going to see a lower valuation and a less number of offers than a peer that has an identical practice in an urban or suburban geography. The other thing is that DSOs love to build density. When they build density in a particular geography, it allows them to enhance their economies of scale. And it's very difficult to build density in a rural or tertiary market as opposed because there's not that many practices to buy. Whereas in an urban or suburban market, there's a lot of acquisition opportunities. Most DSOs today are looking to acquire practices with multiple doctors. The mitigation of key man risk is a huge deal. Doctor turnover, in particular, founder turnover, is the Achilles heel of most DSOs. That doesn't mean if you're a one doctor practice, there's not going to be demand for your business in the DSO world, but we do see higher demand, higher multiples with multi-doctor practices where that production has been bifurcated among multiple providers. Therefore, the business is not so dependent on one particular clinician. That reduces key man risk, therefore increases valuation and demand. Most DSOs are looking for practices with EBITDA of $500,000 or higher and an EBITDA margin of, let's say, 18% or higher. There are plenty of DSOs that are out there buying practices with EBITDA in the $250,000 to $500,000 range, but you see the highest multiples and the most demand above $500,000 in EBITDA. So EBITDA margin at 20% means that you're generating EBITDA equivalent to 20% of your revenue, right? So after all the bills are paid and the doctors are paid a fair market wage to work chairside, you have 20% of revenue left over. Well, in order to generate $500,000 in EBITDA, that means you've got to generate about $200,000 in top line revenue, right? I'm sorry, $2 million in top line revenue. $2 million top line revenue at a 20% margin would throw off EBITDA of $400,000. So somewhere in that 2 million to 2.5 million range from a revenue perspective is typically where you need to be considered a Class A asset by DSO buyers. You also want to take your business to market when you have favorable revenue and EBITDA trends. So DSOs are being heavily scrutinized when they go to recap by institutional investors that look to buy them when they have substantial size to them. And what those investors are looking at is great. You can acquire EBITDA, but do you actually make the practices you buy better? Are you increasing revenue and EBITDA once you acquire these offices. Same store sales growth is a big talking point when a DSO goes to recapitalize. So they love buying practices that have increasing revenue and EBITDA trends. And then they can layer on those economies of scale and best practices to continue to grow the business. So if and when we take a business to market, we're always going to want to go to market with a growth narrative. And if we can highlight recent revenue and EBITDA trends, as well as talk about the potential for further growth post-sale, that's going to increase demand, marketability, and valuation. And then doctor alignment and retention. In a private practice sale, typically you're going to get 100% cash at closing, and your post-closing commitment is going to be minimal, 6 months max in most cases. In a DSO sale, you're going to have a cash component and you're going to have an equity component. And you're also going to be required to stay on for 3 to 5 years. Now, that doesn't mean 3 to 5 years working at the current clip that you're working at. It just means that the DSO wants you to have a vested interest in the business for at least 3 to 5 years post-sale. So it's okay if you want to step away chairside. It's okay if you want to cut back your chairside schedule. As long as you backfill your production with associates and the business continues to perform same or better as it was performing at the time of sale, you're going to be good. There's a lot of autonomy that DSOs offer in today's marketplace from that standpoint. But they want to know that you're not ready to sail off into the sunset. They want to know that your associates are going to be retained and are going to be happy continuing to work in the practice that is now majority owned by a DSO. So let's talk a little bit about practice valuation metrics. What impacts the EBITDA multiple? We already talked about the fact that a healthy EBITDA margin is somewhere in the range of 20 to 25% of revenue. But I always get asked, whether I'm doing a webinar or a podcast or I'm speaking at a conference, what do the EBITDA multiples look like today? And what impacts the EBITDA multiple? Before I go there, I want to make the point that EBITDA itself matters more than the multiple. Every dollar of EBITDA is worth somewhere in the range of $6 to $8 in value, right? Because how DSOs and private equity value businesses is they take EBITDA and apply a multiple to it. The number one way that DSOs are opportunistic or even predatory is to convince doctors that your EBITDA is lower than it is and dangle the carrot of a sexy EBITDA multiple. So I'll explain what I mean. Oftentimes, a doctor will call us and say, hey, Brannon, I've got an offer from a DSO. My buddy sold to this DSO and referred me, and I've got an offer from them. They're telling me my EBITDA is $400,000 and they've made a 7x offer. So 400,000 in EBITDA times 7x is a $2.8 million valuation. And I say, hey, doc, that's great. That multiple sounds, reasonable based on your EBITDA level, but let us do an independent EBITDA analysis and valuation, gut check the DSO's EBITDA calculation, and tell you what we think we could get if we went to the open market utilizing what we call a blind bid process. And oftentimes what happens is we get the financials. I have a CPA on staff. I have a financial analyst on staff. We go through the numbers and we find out that EBITDA is not 400,000. EBITDA is actually 600,000. So at a $2.8 million valuation on true EBITDA of 600,000, the DSO is not even at a 5x multiple. So DSOs are designed to try to get in front of large practice owners without somebody like me at the table, buy low and sell high, to convince you your EBITDA is lower than it is, to dangle the carrot of a sexy multiple, and ultimately you leave a lot of value on the table because you didn't have somebody like me that was controlling the narrative regarding EBITDA. And in a scenario like I just described, the premium that we can generate for our client, if we can get credit for $200,000 in extra EBITDA, right, and then move the multiple by half a turn, we're talking about $2 million in additional valuation compared to that unsolicited offer from a DSO. So this is what a sell-side advisor does. They make sure that, one, you've got as much optionality as possible and perspective as possible by bringing you multiple suitors and multiple offers, and then creating that competitive environment and controlling the narrative regarding EBITDA to hold their feet to the fire and ensure that you maximize your valuation. So make sure that you are controlling the narrative regarding EBITDA if and when you look to take your business to market. So now let's talk about what impacts the multiple. The EBITDA level itself is the number one driver of the multiple. And you can see there's kind of a demarcation point here where, and you've got EBITDA under $1 million, you're trading for 5.5 to 7x, EBITDA in the 1 to 2 million range, 7 to 8x range, EBITDA over 2 million, typically in the 7 to 9x range. You might exceed 9x if we're talking about a large multi-location platform with EBITDA of 3 million plus. That would be an acquisition target for a private equity firm that's looking to buy a platform and start a new DSO, or a business that would be a platform for a DSO that's looking to plant a flag in a particular geography and then grow their density in that geography, with that particular practice being their jumping off point. The number of doctors, we talked about key man risk previously. So the more doctors, the less dependent the business is on a particular provider. Typically, the higher the demand, the higher the multiple. The number of locations. More locations typically equal a higher multiple, slightly higher multiple. However, more locations come with more overhead. So the name of the game is maximizing EBITDA and efficiency. I would much rather take a business to market that's single site, one location business, top line revenue of 5 million with EBITDA of 1.5 million, versus a 3 location business, top line revenue of 5 million with EBITDA of only 1 million. The single location business with EBITDA of 1.5 million is ultimately going to trade for a much higher valuation than the multi-site practice with EBITDA of only 1 million. While the multi-site practice could trade for a slightly higher multiple, it's going to trade for a lower valuation because you're applying that multiple to a lot lower EBITDA figure. So just be intentional if you're going to look to scale a multi-site practice as to how that's going to impact your overhead, how that's going to impact EBITDA. We talked about the fact that DSOs prefer practices located in urban and suburban markets because they want to build density and they want to recruit from a larger labor pool. So all things equal, those practices will typically trade for a higher multiple and have more bids than a practice in a tertiary or rural market. Payer mix, there's definitely a pecking order. Most DSOs like fee-for-service and PPO. If you are exclusively fee-for-service, it may limit demand slightly. Also, Medicaid and HMO, Medicaid in particular, comes with a lot of regulatory compliance and oversight, and private equity tends to heavily dislike regulation and oversight. Therefore, if your Medicaid exposure is above, let's say, 30%, it could impact demand, the number of bids, as well as the multiple and the ultimate valuation. I would say pediatric practices are probably the one carve out to that rule. Most pediatric-focused DSOs understand that you're likely going to have a Medicaid component. Service mix matters, and I would relate this to key man risk. So if you've got a super producer, a doctor that's doing all different types of dentistry, all on 4 cases, and is producing, 2 million plus a year, that practice has a lot more key man risk than a bread and butter practice where you've got 3 or 4 providers attributing to that $2 million in doctor production. Upside potential, I mentioned this earlier. You always want to go to market with a growth narrative. Is there an opportunity to expand the facility, add additional providers, expand the service mix, go multi-specialty? Is there an opportunity to negotiate your PPO plans or negotiate pricing with vendors? There's a lot of different ways that we can pitch the growth potential of a practice, whether it be from a revenue perspective or a bottom line EBITDA perspective. Your post-closing plans are going to matter, right? What is your runway to exiting the business? Typically, younger practice owners are going to fetch more demand and a higher EBITDA multiple than older practice owners that are closer to the tail end of their career. And the last one surprises a lot of people. The owner's personality. A lot of people think private equity DSOs, all they care about is money when they're looking at valuation. But the reality is this: if they fall in love with you, if they feel like you're going to be a good partner, they will pay more for your business. So we always tell our clients, hey, good cop, bad cop. Let us handle all the negotiation, all the posturing. That's our job. You don't have to worry about that. You focus on being the most charismatic version of yourself. Focus on talking about the passion for dentistry, your patients, staff, your practice. Get to know the people. Focus on fit. Focus on finding the right partner. Let us take care of the economics. And if we play that right, typically the outcome is really, really good. I think it's important to talk just briefly about aligning incentives with doctor partners, um, minority partners, as well as associates. I say this because we're working with a lot of businesses that are multi-doc, where the founder either owns 100% of the business and they have associates that don't have equity, or they own, let's say, the lion's share of the business and they have some minority doctor partners. And when they're ready to monetize the business in the DSO world, because it's worth exponentially more to a DSO than it is to a private party or an internal succession, the minority partners or associates, dig their heels in and are not willing to participate in that transaction and essentially block the sale. So I think it's critically important that if you ultimately want to monetize all or a piece of the business in a DSO affiliation, that you're very thoughtful in if and when you offer equity to associate doctors, and understanding that the more partners you have, the more complicated it is to monetize the business in a DSO affiliation. You're going to want to make sure that you have it tag along, drag along right, meaning a unilateral legal right to monetize the business as you see fit. And they can either tag along or you can drag them along in the transaction. That said, if they're a major producer, even if you have that unilateral legal right and they're not willing to go with the flow and they dig their heels in, you're going to have a problem, because the DSO is going to want to make sure that they're going to have complete doctor retention and security in production and revenue post sale. So this is why we talk about this particular subject. I think you need to be prepared for the fact that you might have to incentivize your associates to sign on with the DSO at the time of close via some type of retention bonus or equity. Most DSOs have developed some on-ramp for equity for associates because, again, doctor attrition is their Achilles heel. They want continuity, especially from a provider perspective. But this has become more and more of a talking point as we take more and more of these group practices to market, where there's a majority owner or a single owner, and then we've got associate docs that we're going to need to retain in order to consummate a sale. DSO deal structures, I could really talk about this all night because they're very nuanced. But what I will tell you from a DSO deal structure perspective is that there's simply always going to be a cash component. It should be sizable, 50 to 70% of the deal, and there's going to be an equity component. Holding company equity is equity in the DSO. You actually own stock in the parent company of the DSO. That form of equity is not practice level equity, so there are no distributions associated with that equity. You can typically monetize that equity in part or in full at a recap event, hopefully at a handsome return, a 3 to 5x return on invested capital. The benefit of the holding company equity is that you're diversified. You own a small piece of all the practices within that DSO's portfolio. The other benefit is that holding company equity typically has higher upside than joint venture practice level equity. And you have a higher probability of being able to liquidate more of that holding company equity at recap as opposed to joint venture equity. The big downside in holding company equity is that you don't really have control over the quality of the assets in the DSO's portfolio. There's not a clear line of sight into how that equity is being valued at the time you purchase it. And there are no distributions associated with that equity on an ongoing basis. So if you sell your business in a pure holding company structure, where let's say you take 70% cash at close and the remaining value of your business is exchanged for stock in the DSO's holding company, you no longer own any of your practice and you're no longer going to get any of the ongoing EBITDA. You move into kind of an eat what you kill scenario where your chairside compensation is going to be your only income until you reach that recapitalization event. Conversely, in a joint venture model, this is a true partnership model. Let's just talk about a 60-40 deal. Let's say you monetize 60% of your practice, you get 60% cash at close. And then you actually retain 40% equity in your own business. So you're partnered with a DSO rather than being partnered with another clinician. They own 60%, you own 40%. They're going to get 60% of the ongoing EBITDA. You're going to get 40% of the ongoing EBITDA. So the benefit in a joint venture model is that, one, it's a true partnership. I would say you probably have a little bit more control over how your practice operates post-affiliation. Two, you have those ongoing pro rata EBITDA distributions, and you are able to monetize a piece of that joint venture equity at a recapitalization event, but typically only a piece, right? So the DNA of a joint venture DSO, at some level, there's always got to be a clinician that owns a piece of that practice. So there's always going to be this residual joint venture component, whether it's 10, 15, 20% of the business, that has to be owned by a doctor. So if and when you want to eventually exit the business, you have to sell that component to another clinician. Now, some of you may say, well, that doesn't sound marketable. The reality is that 10, 20 years ago, I would agree with you. It was not marketable. Most dentists aspired to own their own business, and they were fine with the responsibility and the obligation that came along with that. But I would say that this new generation of dentists, many of them want to be owners, but don't want the responsibility. They don't want to incur the debt. They don't want the responsibility. So owning a minority interest in a practice that's majority owned by a DSO, where the DSO can leverage those economies of scale and help them operate the business from an operational administrative perspective, is attractive. So we have seen multiple clients exit their residual joint venture equity component when they're ready to exit the business. A hybrid model means that it's essentially the equity component is bifurcated between some level of holding company equity and some level of joint venture equity. So let's say we're doing a 60-20-20 deal, 60% cash at closing, 20% holding company stock in the DSO, 20% retained equity in your own practice. And then the roll-up concept, this to me is not a legitimate DSO deal structure. This concept is that you can combine 5, 10, 15, 20 practices and pretend like they're one business. Take them to market all simultaneously and sell them to a DSO or private equity firm at an elevated multiple compared to what they would trade for on their own. Most of the time, the people that are pitching this concept are some type of consultant or industry influencer. They're going to charge you an initiation fee to join the group. They're going to say, hey, we need 2 years of maturation, operating and integrating and looking like one business before we monetize the business. And you're going to pay me $5,000 a month to do so. The reality is that unicorn deal that they're promising is going to walk in the door 2 years from now at an elevated multiple is never going to happen. And it's death by a million cuts. They're in it for the fees. They're in it for the initiation fee. They're in it for the ongoing management fee. They don't ever need to consummate the transaction to make a lot of money. So I would caution you to not walk away, but run away from anybody that's trying to pitch the roll-up concept to you. I predicted years ago that none of these roll-ups would ultimately transact at a favorable multiple compared to what the underlying practices would trade for on their own. Sure enough, years later, none of them have traded. And many of those doctors are now getting frustrated that a transaction has not occurred. They're defecting from the group after spending hundreds of thousands of dollars in fees and hiring us to sell their business independently. So please don't fall for that trap. Let's talk about keys to maximizing your outcome at sale. You want to make sure that you position your practice as a Class A asset. We talked earlier in the presentation about what that means, right? You want to be a multi-doc practice, ideally 8+ ops in an urban or suburban market. You want to be generating top line revenue of 2 million plus and EBITDA of 500,000 plus. That doesn't mean that if you don't check all those boxes, you're not going to get a good outcome. That's just if you check every box, you're going to get the best outcome you possibly can. So you want to make sure that you're being mindful about positioning your practice for success. And that may mean doing a evaluation with us now and having us coach you on, how to reverse engineer the outcome that you ultimately want to achieve 3 years from now. We do a lot of that type of consultative approach with our clients in advance of a potential sale. So I would encourage you that if you aspire to sell your business in a DSO affiliation, start planning sooner rather than later so you have a little time to make sure that you take the appropriate steps to position your practice as a Class A asset. Choosing the right time to take your practice to market. Now, I'm not talking about timing the market from a macroeconomic environment perspective. What I'm talking about is timing the market as it pertains to the performance of your individual business. You want to sell at a peak, not a valley. You want to sell when you've got favorable revenue and EBITDA trends. You want to sell when you're as efficient as possible. And all too often, sometimes we see people miss the boat, right? They take their eye off the ball as they get a little bit later in their career. And especially with the inflationary creep on overhead we've seen over the past few years, the revenue growth has not kept up with the overhead growth. And it starts to squeeze that EBITDA. And then you're getting closer and closer to the tail end of your career where, maybe a few years ago you had a 5 in front of your age and now you've got a 6 in front of your age and you want to sail up into the sunset in 3 years rather than 7 years. Your cash flow has been squeezed and the asset's not going to be worth near as much as it was worth several years ago. So you want to make sure that you're thoughtful in deciding when you want to monetize your business, and you do it when you're on a peak and not a valley. If you're going to go down this road, the private equity world is shark-infested waters, right? So you need to make sure that you have proper representation. It takes a village to get a deal done properly. You need us. You need a sell-side advisor at the table to create a competitive environment, to hold the DSO's feet to the fire, to keep them honest from the perspective of controlling the narrative regarding EBITDA, to leverage that competition to increase the multiple, and to give you as much optionality as possible to help you find the right partner for your particular practice. If I take 10 practices to market, they might sell to 10 different buyers, depending on our client's why, right? What are their goals? How is their practice engineered? How do they view risk, from an equity perspective versus a cash perspective? So there's a lid for every pot. And just because your buddy sold to one particular DSO doesn't mean it's the right fit for you. So you've got to have your financial advisor at the table. You've got to have a sell-side advisor at the table. You've got to have a strong dental attorney at the table that's well-versed in DSO transactions. You've got to have a CPA at the table that can help mitigate the tax implications. And then you've got to make sure that your spouse is on board, as well. I have had spouses kill deals a couple of days before closing because my client unwisely decided to wait until the last minute to tell them that they were planning to sell their business. So make sure that you've got alignment with your whole team, including your spouse, from day one. And make sure that you've got proper representation. You can only do this once. You got to do it right. That leads me to my next point. Do not respond to an unsolicited offer. DSOs have built massive marketing machines. Many of you probably receive daily, weekly, or monthly cold calls. People might walk in your door, some type of mailer that you might receive, or you might have a buddy that's sold to a DSO that's calling you, trying to convince you to enter into a conversation with that same DSO. They're being compensated to do so, by the way. So just understand that a DSO's dream is to do a deal in the dark, for you not to have proper representation, and for you to accept that unsolicited offer without shopping around. And if you don't create a competitive environment, if you don't create multiple offers, if you don't control the narrative regarding EBITDA, if you don't pay close attention to the details, right? The fit, the deal structure, the type of equity, how it functions, you run the risk of making some huge mistakes, which include potentially leaving millions of dollars on the table, selling prematurely or selling to the wrong DSO, or not fully understanding all the levers involved in the deal and how the equity functions both along the way and at a recap event. So we look at our job first and foremost to educate doctors regarding what is your business worth, what are your options, and when is it the appropriate time to pull the trigger on going to market. and help you execute at a very high level, irregardless of how you decide to monetize the business, whether that's selling in a traditional sense to another clinician or ultimately pursuing a DSO affiliation. So this is our process. And once we wrap the webinar, you will be prompted to go to a free consultation page. I encourage anyone that watches this webinar to schedule a free consultation. That's a 30-minute, no obligation, confidential call with me, just to get to know each other, right? I want to learn a little bit about your business, understand if it makes sense to do a deep dive, do an even analysis, do a valuation to quantify your options. And if we go through the valuation process, you'll never feel any pressure from me or my team to take your business to market or to go the DSO route or the private buyer route. That is an education process. It's designed to arm you with the facts that you need to make a good decision for the future of your business. But let's say we have the discovery call, get to know each other, and we decide, hey, it makes sense to do the even analysis, do the valuation. We'll do that. It typically takes about 2 to 3 weeks. The cost is $2,500. That's our only upfront fee. We'll go over it together. We'll talk about our findings. We'll do some economic modeling to show you how each option available to you would play out, let's say over a 5-year window. And then we'll decide, what's the appropriate path to go down and when's the appropriate time to pull the trigger on a sale. When it's time to go to market, our job is to create essentially a bidding war among as many buyers as possible to help you maximize your valuation, find the right fit, negotiate the best deal structure we possibly can. And then once we enter the closing process to help you navigate the quality of earnings process, the confirmatory due diligence when DSOs inevitably, whether internally or through a third-party accounting firm, beat the crap out of your EBITDA and basically argue with us regarding what your true EBITDA is and whether the offer they made on the front end was fair. I feel like 50% of our time is spent arguing with DSOs about EBITDA on a daily basis, but we're there throughout that closing process to defend the EBITDA and make sure that there's not a retrade. We're also there to help you navigate the legal agreements, navigate the integration process, coach you on when to tell your associate doctors, when to tell your team, what to tell your associate doctors and your team, and how to prepare your business for a seamless transition. I want to talk just a couple of minutes about a couple of case studies because I think these are helpful to conceptualize, how we work, the type of clients that we represent. So case study number one, this is a 40-year-old doctor in Tampa, Florida. His business was growing rapidly. He was selling to de-risk, and he was planning to expand his facility substantially and hire 2 more doctors. And he has a young family. He didn't want to do that on his own. He didn't want the operational burden of managing a much larger business on his own. He also didn't want to spend the capital and take the risk on his own. So he decided, hey, before I do this expansion, why don't I take on a partner and then we'll participate alongside each other in this expansion and they can help me equip the facility for half of what it would cost me because of their economies of scale. And then they can help me operate the business from an administrative perspective on a go-forward basis. At the time we went to market, his business had revenue of $4.3 million, EBITDA of $1.2 million. So very healthy, over a 25% EBITDA margin. We did a valuation and told them that we thought we could get around $8 million by utilizing that blind bid process and creating that bidding war on the open market. We also received 9 offers from legitimate DSOs, and we closed the deal at a valuation of $9.6 million, 8 times EBITDA. And he did a 70-30 joint venture structure. So he took 70% cash at close. He retained 30% equity in his practice on a go-forward basis. He did that because he's got a long runway to exiting the business, and the business is going to grow exponentially once he expands the facility and hires a couple more docs. So he wanted to retain a meaningful equity position in his own practice. So again, valuation of $8 million, that was just to set a baseline expectation with our client. By utilizing that blind bid process, we were able to bid up the practice to a valuation of almost $10 million, an 8x multiple. Fantastic outcome for this client. And he has a 5-year post-closing commitment, young guy, Tampa's home. He's not going anywhere. Super happy with that outcome. And I want to show you this one because this highlights how opportunistic / predatory DSOs can be. So this is a client in the Atlanta area. He was 58 years old at the time he hired us, and he was selling to obtain administrative support. He was close to the tail end of his career and still loved dentistry, loved his patients, but didn't love running the business. So wanted to partner with a DSO to get operational support and also just for succession planning purposes. Revenue of 3.6 million, EBITDA of 1.2 million. Another super efficient, super healthy business running at about a 33% EBITDA margin. Now, he already had an offer in hand from a legitimate DSO at 6.8 million that his buddy had sold to and referred him to. And he was about to sign it. He sent the LOI to his attorney. His attorney said, hold on, I'm out. Is this the only offer that you have? And he said, yes. He said, do you have representation? Did you have a broker? Did you have a sell-side advisor? Answer was no. I negotiated this deal on my own. And attorney said, hey, call Brannon and his team. At least let them do an even analysis, do a valuation, and see what they think they could fetch if they took the practice to the open market. He wisely hired us to do a valuation. We said, hey, doc, look, that's a legitimate DSO. 6.8 million sounds like a good offer comparative to selling it to a private buyer, but we think we can make it substantially better. We think if we take the business to market, we can fetch a valuation of 8 million. He was skeptical if we could really move the needle that much. And he ultimately wisely hired us. We ran a very limited, narrow process. He didn't want to talk to 20 different bidders. We shopped it to 7 bidders, including the DSO that had made that off-market $6.8 million offer. We ultimately got 5 offers. So the DSO that he was talking to made us a revised offer, and then we got 4 other offers. We ultimately closed the deal at a valuation of $9 million, 7.5 times EBITDA. He did a 75-25 holding company structure, so he took 75% cash at close, 25% holding company stock in the DSO, and agreed to a 5-year post-closing commitment, but he only has to work chairside for 3 years post-sale. The DSO is well aware that his goal was to cut back substantially and eventually transition out of working chairside. So unsolicited offer, 6.8 million. Valuation, 8 million. After going to market, utilizing that bid process, we ultimately closed at 9 million. Huge premium compared to the unsolicited offer. A $2.2 million premium. What is that? About a 33% markup compared to the unsolicited offer? Guess who it sold to? It sold to the same DSO that made the unsolicited offer at 6.8 million. The only thing that changed is we walked in the room and we held their feet to the fire. We controlled the narrative regarding EBITDA. We filled the table they were sitting at with other bidders, and suddenly their behavior changed and their offer went up 2.2 million. So amazing outcome for that client. I could tell stories like that all day long, but that's the value that we deliver to our clients on a daily basis. So I mentioned earlier, I encourage you to schedule a confidential discovery call with me. You can simply text me. That's my cell phone number. And schedule a time to talk. You can click on this QR code and it will take you to that free consultation landing page on our website that you can fill out. It'll send me an email and I'll reach out that way. And once we wrap the webinar tonight, you'll go to that free consultation page. So would love the opportunity to get to know you, learn more about your business, see if it makes sense to do a deep dive, do an even analysis, do a valuation, and take the conversation from there. So at this point, I will kick it back over to Assaf and Charlie. Guys, I know you have some cool stuff to talk to us about tax mitigation strategies. So take it away.
Thanks, Brannon. That was great. And yeah, you're right. I mean, one of the things, actually, Brannon and I spoke about this before, is that, you know, when a lot of dentists sell their practice, again, very often it's their largest asset. Very important for them to maximize the value of that so they can retire the way they want to retire for them and their family. But one of the things that sometimes stands in a way, sometimes even stands in a way of them deciding to sell the practice, is that looming tax, potential tax hit that they're going to take when they sell the practice. And depending on what state they live in, you know, a lot of time you're going to have a capital gain. The vast majority of the value of the practice will often be goodwill. And so you're looking at, 20% long-term capital taxes, 3.8% net investment income tax, and then whatever state you live in can add, easily as much as 6-7% taxes on top of that. So you're looking at a lot of times roughly 30%. It varies depending on where you live. And so that is something that's a huge concern for a lot of our clients. And so we've been looking at strategies of how do we offset, how do we potentially offset or defer some of those taxes. And I'm going to share one possible case that that has worked for our clients um, to help with that. And again, this shows the importance of again working with a team of professionals, because as you can see on the slide right now, when you have a team of professionals working on your behalf, collaborating on your behalf, everybody brings their expertise in different areas, and therefore you don't end up in a situation, hopefully later on, saying, "I wish I had, a tax expert or a CFP or a sell side advisor," as Brannon was saying. And so I'm going to go through this concept very quickly. This is a concept that basically allows people to take money from a sale of an asset, in this case, the sale of a dental practice that has a high level of capital gains in it. And there's an investment strategy that involves long, short investing that allows tax loss harvesting in much higher proportions than what most people are used to. And you can see right now on the screen, these are some of the strategies, and I'm not going to get into the detail of them. Obviously, if anybody has questions, we can get into the detail about any of these strategies and exactly how they work. But the bottom line is that we're able to produce um, capital losses on a portfolio that is invested a certain way. And it can be invested aggressively, conservatively, moderately, really can be invested in any way depending on the goals, risk tolerance, and timeline of our clients. It can be in T-bills, it can be in mutual funds or ETFs. It really varies. But the portfolio will perform the way the portfolio is performing based on how it's invested, based on what's going on in the market. But in addition to that, we are able to tax loss harvest the part of the portfolios that move against us while retaining the parts that are moving in the direction we wanted to move, and produce capital losses to the tune of as much as 60 to 70% in 1 year, in the first year of doing this strategy. And so if you have, for example, a sale of a dental practice let's, I'm just going to use 10 million because it's an easy number. You're able to produce in 1 year as much as $7 million worth of capital losses, while the portfolio itself is performing the way that it's performing based on the investment. It's the portfolio itself doesn't have to lose for this to happen, and then offset some of those gains, defer those gains, because you're effectively transferring those gains from the sale of the dental practice into the portfolio, because we're retaining the gains of the assets that move up, we're harvesting and then redeploying the money from assets that move down, harvesting those losses so we can offset the gain from the sale of the practice. And I'm going to show an example of how this could work. This is a statement basically showing, $6 million going in the middle of the year, roughly July. During that period of time, during that quarter, middle of July through the end of September, these assets moved from about 6 million to 6.2 million. But at the same time, I'm going to go to the next slide. It shows the tax loss harvesting. You can see that there was significant tax loss harvesting, close to $800,000 in tax loss harvesting during that period while the portfolio actually went up. Now, if the market was down, the portfolio could have moved down, but the tax loss harvesting works regardless of the direction of the market, because we always have positions that we can tax loss harvest while retaining, again, the positions that move in our direction. And that same portfolio in the next quarter goes from 6.2 to 6.3 million. And at the same time, there's another million or so in tax loss harvesting that is produced. So with the right planning, and especially the earlier we know and the earlier we can plan for this, we can actually produce enough harvested capital losses to offset a huge part of the capital gains that will be created from the sale of the practice, and then defer those gains for the foreseeable futures, which can save a tremendous amount of taxes that stay invested and therefore compound for our clients, putting them in a better financial situation down the line. Now, again, different clients will invest differently, will have different risk tolerances. There's no specific model or portfolio that's right for every client. We spend a lot of time getting to know our client's situation. Again, the risk tolerances, what's important to them, so we can invest in a way that makes sense for them. But this is just another example of why it's so important to work with a team of professionals that can collaborate on your behalf and make sure that, again, we're looking at all of the angles, because this will actually typically be the biggest financial transaction of your life. And it's important to plan ahead and look at it from just all different sides. So with that, I'm going to turn it back to Brannon. I'm going to put the slide with our information on it, so you can reach out to us. Many of you already have this information. But Brannon, I just want to thank you. You're an incredible speaker. I know that you've done so much good for your clients and continue to do so, and really enjoy working with you. So thank you for spending the time today. Hey, Brannon, you're on mute.
Thank you. I appreciate you guys having me on, and commend you for being proactive and educating your client base. And I appreciate everybody for attending, and please don't hesitate to reach out with any questions or to schedule a discovery call. But look forward to getting to know all of you, and have a great evening.